Good evening, everybody. We're still waiting for a few more participants, but I think we are ready to start. So I wanted to welcome everybody to our second budget webinar that we did. We did our first one last year. We believe it was extremely successful, and we hope that you find this webinar insightful and beneficial. I know many of the attendees of this webinar this evening. However, for those that I have not met, I'm Andre Kaplan. I'm the Chief Financial Officer at Orsid, New York. I have been navigating budgets in the real estate industry and finances. I'll just put it as for many years, of which it has been a true pleasure to serve you all for the last 21 years at Orsid, and I'm looking forward to sharing what the good and the bad news for what it will look like for 2022. Before we get into the details of what to expect, I wanted to just introduce you to our controllers that are behind the scenes, and Joe Dodai, Ben Hawkins, and George Petrides. Some are able to attend this evening that are part of the panelists, you can see, and we have all worked together for many, many years. I also wanted to introduce you to Erin Sirachi and Desiree Welsh, who are both new additions in the last few years to our team. And I wanted to thank this team for all their input in creating tonight's content. I also want to acknowledge Ben Hawkins, in particular for his involvement in assembling this webinar for us this evening. This presentation is being recorded and will be made available to you. So you can relax and enjoy it, and we will be sending it out tomorrow, and that you will each have a copy. Let's get into the details of the budget compositions, which I wanted to just recap. So for most buildings, in fact, for all buildings that we represent in terms of cooperatives and condominiums, the only difference with condominiums is that the owner pays the real estate taxes directly. However, it's important for those board members that have attended tonight that represent a condominium that it's equally as important what we're going to discuss tonight in terms of real estate taxes, which is the only separation, is because it's the cost of direct ownership. And I think it's good to look at the whole picture. And when we look at the budget composition, and just as a recap, which we do each year, as a reminder for residents and owners across the board, is that we have very, very little control in terms of operating expenditure for these buildings. And as you can see by the pie chart that we've assembled, is that the biggest pieces of the pie, starting with real estate taxes, which on average for our buildings today represent 53% of your budget. And this has crept up over the years. In the last, I would say, 2 to 3 years, most buildings, in terms of the tax composition for your entire budget, is over the 50% mark. Historically, they were in the 40s, and year over year, as we've seen the high increase in real estate taxes, we're now at the 53% mark on average in terms of those revenues. Payroll is 27%. In most building cases, they are governed by the 32BJ union contract, which is coming up for renewal this year, and we're going to talk about that in a little bit more detail. Financial, in terms of the mortgage, which I will be touching on. And generally, most buildings have underlying mortgages. In fact, I would say 99% of our portfolio in terms of co-ops have underlying mortgages, and they're locked into generally 10-year notes. That represents 7%. Utilities, 5% of the budget. Insurance and professional fees, 4%. And other, which is not really discretionary because you need to maintain your building, 4% is repair, supplies, and other. So most of these expenses, as we know, are fixed, beyond our control, and I'm going to talk a little bit in detail under each category of what's to come and what is the outlook for 2022. Let's start with the biggest piece of the pie, which are the real estate taxes and how they are calculated and how they are billed, what has transpired, and what's to come. What's to come, I don't have all the answers, but I'll give you the little insights that we do have. So let's start on the basic calculation of the real estate taxes, because this is important, because it's going to feed into a little bit more of a bigger discussion. So the first part is the assessed value. So real estate taxes, the city calculates an assessed value. It's not a market value. It's not what your apartment is worth. It's not what the real value, market-related value of the building is. It's an assessed value that is determined as a function as if you were a free market rental income producing building on a per square foot basis. So the city takes rental on a per square foot basis as comparables in your neighborhood, and they take that dollar per square foot and they apply to the total square footage of your building. Now, I know we're going to get into the discussion, well, rentals have declined, and we're going to talk a little bit about that. That's how they come up with the assessed value. And they take that assessed value and they reassess New York State, and they revalue every single year. And then it's phased in. That new assessed value on a rolling average is phased in on a 5-year cycle. So each year the assessment goes up, and then it gets phased in. And we talk about the phase-in value, which is what they actually bill your real estate taxes on the transitional assessed value. So say, for example, the assessed value would go up by 10% each year, only 2% would apply to the increase of which the assessment that you would be billed in that given year. Depending, we have seen some unusual circumstances generally during the pandemic, which we're going to talk about, where it's the lower of. So in very extreme cases where the city or the assessor have made some arbitrary adjustment to your assessed value of your property, if the actual assessed value is lower than the transitional assessed value, then they will bill on the actual assessed value as opposed to the transitional assessed value. But that's just generally hypothetically. So once they set the assessed value, they are then going to apply the tax rate. And the tax rate is set and really backed in by the budget of the city that they apply, and that is applied to the assessed value to come up with your actual dollar amount in terms of the real estate taxes. That's calculated on the gross real estate taxes, so they'll come up with a gross amount. The real estate tax abatement that co-ops and condominiums have enjoyed was renewed and extends to 2023 so far that we know. And I just want to take a step back to last year for those of you that attended the webinar and those who didn't, to understand the rationale and the approach that we took for budgets last year. So at this time last year, we were deep into the pandemic. There was a huge amount of uncertainty, and we did not have a real picture as to how the city was going to respond to assessed values. We knew that clearly values were down. dark time and not, at that time. We knew values were down. We knew there were a huge amount of vacancies. There still are in terms of the commercial arena and how the city would respond to that. The unknowns at that time were two factors. One is we were not clear of how much federal funding and how the city would react in terms of balancing their budget. That was a concern. And we knew that values were down so that the city would have a hard time justifying increasing assessed values as we have seen historically. So our concern was last year that the city clearly needed funding. We were unclear what we were going to see from Washington. And so as we had seen in prior years, after September 11th, there was a tax increase of almost 18%. The economic crash in 2008, we saw adjustments in tax rates that were applied that increased by 11%. So our concern last year was that they would go after us in terms of making a dramatic increase in the tax rates of 10% plus. So we were conservative in our approach last year with our budgets, where we kept the assessed values at a moderate level, small increases, not like we had seen in prior years, because we knew that something would have to give in terms of assessed values. However, we were especially conservative in terms of tax rates, and in most cases with buildings, we assumed a 5 to 10% increase in the tax rate for 2021. So in a way, this is going to pave the way for your 2022 budget, because what actually happened is generally across the board, what we saw and what transpired was that the city and the assessors reduced the actual assessed value by approximately between 9 and 11%. So all assessed values went down. Okay. And then in terms of the tax rates, which I'm going to my next slide, you can see that the tax rate has also gone down slightly. And you can see that we haven't had much movement in the tax rates. And I went back to as far as 2007, 2008, we saw slightly bigger increases. But since 2010, 11, we've had decreases. We haven't seen big movements in the tax rate. So I want to clarify, what this means and where we're going to go. So even though we saw a large decrease in assessed values, this doesn't mean that your taxes are going to go down dramatically. And I try to demonstrate over here on the side in terms of the impact on budgets in terms of the 2021-22 tax year, what this really means. Because as I mentioned, there's a 5-year phase-in of the assessed values, even though in this particular example, you can see in the 2020-21, the assessed value was $23,300,000. It went down by 11% in 2021-22 to $20,700. But because of the phase-in, as you can see, if you look at the transitional assessed value, the TAV, the 21,040, and then it became 20,000, it matched the actual assessed value. Taxes in reality, in terms of an assessed value, only went down by 2%. So you're not going to see, you're going to definitely see a reduction, but you're not going to see the 11% because of the massive reduction in the assessed value. And then going forward into the 22-23 tax year, because this is marked on rental value, and there's a lot of confusion in the market because the two factors that play into assessed values. And the one is buildings where they have more than 2,500 square feet of commercial space are required to file with the city what's called an RPIE, a real property income and expense. And that provides vacancies, dropping commercial rents, all that data, which is going to flow through to the city to help assessors make necessary adjustments. However, on the residential, not on the commercial, but on the residential rental side, which is what in theory, the assessed values are based upon on a per square footage, where yes, there was a dramatic drop from 19 to 20, and hence assessors anticipated that drop while we are seeing the 9 to 11% drop in assessed values now. However, if you look at current market conditions, and it's hard to believe, but it's fact, is that we are starting to see that the residential rental market in New York City is starting to strengthen. And that is going to cause, we believe, some confusion with the assessors, number one. And number two, again, this is going to be a function of what the city needs in terms of funding. So there's going to be some happy medium in terms of assessed values and tax rate in order to balance the budget of the city. And then again, it's a function of how much funding they're going to receive elsewhere. So all this in terms of what are we going, what is 2022 budget for our buildings going to look like? The good thing is that we made the necessary adjustments in the 2021 budgets. So we have addressed those adjustments in terms of a rate increase, and we kept the assessments valid. We're not going to take into account this adjustment and the reduction in the assessed value, because if they keep the rate flat, they're going to adjust the assessed values back to where they were in 2021. But we've already made those adjustments in your budgets when we did the 21. So for 22, we believe that your real estate tax number, which is your biggest component, as we spoke about, the 53%, is going to look relatively flat for the 22 budget year, which is a positive. There are more positives to come, we hope. And I'll tell you a little bit about the positives that we believe, and speaking to many of the tax cert attorneys, and what is going on in the industry. I spoke to Mary Ann Rothman of the New York Council of Cooperatives and Condominiums, and they're hoping that that tax relief is on the way, more tax relief is on the way. They're hoping that there is more tax reform that is on the way. But with these reductions of the assessed values, and as data as a direct result of the pandemic continues to flow through, each year, your tax cert attorney in every single of our buildings, including condominiums, we file a tax petition with the tax courts unless we have received an offer, an actual offer of reduction, which preserves your right for us to go back and argue your case before the courts, going back 5 years in terms of reductions, and the market data that is starting to flow in is certainly going to help those arguments in terms of achieving offers in terms of reduced assessed values. Not only that, in terms of your tax cert attorney, we go before the tax commission each year in March of each year. And we also have the opportunity to go back to the tax commission where we have not received an offer, going back in the last 2 years, which is going to be particularly relevant to all of you and your buildings in terms of value. So we're hoping, and they're hoping, that we're going to see some action and some further tax relief. However, again, it's a function of what the city needs to be funded and to balance their budget. So we are hopeful. However, again, it is a function of funding that is needed for the city. So those are the positives. I just want to double check my notes to make sure that I haven't missed anything. The one other point that I wanted to clarify with you is that, just as a reminder, most of the buildings have a financial year, which is a calendar year from January to December. And the city, in terms of real estate taxes, runs on a fiscal year from July 1 to June 30th. So the adjustment in assessed values we're going to see again in June of 2021. Generally and historically, in terms of any adjustments that could happen in terms of the tax rate, are only passed in November. Even though they're meant to be passed earlier, are generally only passed in November, or in some cases, January of the following year. So even if there is an adjustment in the tax rate, we believe that we will only have to address that adjustment in the tax rate in January of 2023, which means that we will address the tax rate at this time next year, when we start preparing your 2023 budgets. So that is what I have to share with you in terms of real estate taxes in a nutshell. Let's go on to the next section of the pieces. I've covered the tax rates with you, so we shared that. Let's talk about the next biggest piece of the pie, which is payroll and related. So it's payroll and benefits all included. And 2022, in terms of this section of your budget and this piece of the pie, for those buildings where you have union employees, it's a union contract renewal year. It renews in April. And there are a couple of factors that we need to consider. So number one is your staff were classified as essential workers during the pandemic. And that has put an enormous amount of strain on many of those staff. And, we are seeing indicators that in this contract negotiation, there will be a push for more benefits in terms of time off and a higher pay increase and benefits and all that goes with it. The negotiations, we're still far out, but I wanted to, we did a little bit of a look back so that we can try and set our expectations for 2022. And if you look at the graph that we established in terms of union increases, and this includes benefits, so it's an all-in package, since 2009 to date, you can see that in 2009, the average cost for a doorman or a porter was $58,000. Today, the cost of the average cost, all in with benefits, of a doorman porter is $101,000. And overall, year over year, including summer relief, overtime, vacation time, and everything, and sick time, and everything that goes with what is mandated in terms of the union contract, year over year, we have seen a 4.5% increase. Because of the additional impacts of COVID and working conditions for union workers, we believe that this particular union contract renewal year is going to have very, 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 very tough negotiations. So what we have done, and we're already mobilizing at Orsid, is we have set up a strike task force to start working on this, because this is going to impact your budget. It could impact your budget. Not only we are going to assume the necessary average increases that we've seen, we're going to actually take the 4.5% that we've seen generally for the last 12 years, and we're going to push the 4.5% to 5%, because we believe that there might be some additional costs or time that will be achieved in this negotiation year, and so we're going to be conservative with the 5% increase overall. However, there are additional costs that we need to take into account. God forbid there is a strike. And so we need to prepare, building ID cards. There's going to be, making sure that the front door locks, that every resident has a key. My dumpsters for garbage, security guards costs, and securing those security guards ahead of time, and there are costs involved in that. And there's a lot of preparation that goes into having sign-up sheets for volunteers, for residents, in terms of basic building services. So we're mobilizing that. We will be communicating this with you, and we will, when we discuss your budgets in your board meetings, we will be making we will be putting in a contingency cost to take in some of these factors that I have mentioned, and it's important for the budget plan that we are well prepared in advance, and that we make that a function of your budget going into 2022. Moving on, I'm not going to go into this section in too much detail because looking at the attendee list, I do not believe that there is a particular building that is attending tonight that is going to have to address this issue, but you might hear about it in the industry, and I wanted to just put it out there, and that to make sure, and each of our account executives will be reaching out to those buildings individually to discuss this if it applies to your building. So there is a new prevailing wage requirement for co-op and condominium abatements. So generally, the abatements are 17.5, represent 17.5% of your real estate taxes. So you get the abatement, it's like a discount in your total real estate tax for your building, which is 17.5%. So any building with an assessed value ratio over $60,000 and does not utilize union labor, or if they do have union labor, but they utilize other building services such as security guards, in order to retain the co-op abatement for all residents, there will be a prevailing wage requirement. So any building that has an assessed value of over $60,000 does not utilize union staff or utilizes alternative continual building services where those services are provided by an outside vendor that works at the building more than 8 hours per week, will be subject to either pay a prevailing wage, which is still to be established by the city comptroller, or the option of losing the 17.5% abatement, or we could just refer to it as a discount on the real estate taxes. So we could see having to make some really, really big adjustments in terms of prevailing wages, whatever that might look like. We believe it could be, including benefits, as much as $40 an hour, which equates to what a union wage plus benefits looks like today. The notable, exceptions, if you're a building with under 30 units and an assessed value of over $100,000, that will apply to you. The deadline for this compliance is April. So we will have to attest that we are paying all building services as classified and non-union staff the prevailing wage that is still to be set. The simple analysis, and we'll be working with those buildings directly, is what does that 17.5% cost equate to in dollars? And if we had to pay the equivalent of a prevailing wage, what does that equal? And look at the differential and see where the cost benefit is there. There's still a lot of unanswered questions as to how this is going to flow through in terms of established third-party vendors that work in the building more than 8 hours a week. So there's more to come, and we will, give you more information on that as we receive it, but we will be talking to those buildings directly with that in mind. We're going to move on to our next slide, which is utilities. And this was interesting. So, last year, deep into the pandemic, gas, because in terms of usage, was relatively flat. We were advised and we were aware that the gas commodities were going up. And so you can see in terms of the graphs that we have shared with you, you can see from December of 2020 over here and going all the way through to September, you can see that the price of oil and natural gas has dipped and is on the way up again. In terms of the gas, suppliers are making themselves whole in terms of the lack of usage or the low pandemic usage. And they also have the ability to impose surcharges. So we know that commodity prices are going up. We were warned last year that we should anticipate this, and therefore we believe, and our energy partners, because of the makeup of low usage and commodity prices, that natural gas prices will continue to climb into next year, and that we are going to need to make some budget adjustments to take into account this climbing cost. Not only that, because gas is used heavily to produce electricity, and so therefore electricity rates will remain on the higher side. And not only that, Con Edison has the ability to impose surcharges on the delivery. So while we look for ESCOs in terms of the supply, Con Edison will continue to drive those delivery costs, which therefore we believe, again, electricity rates will continue to stay on the high side. Completing, and the worst is still to come, completing the trifecta, the cost of oil. Production has been hard and has been tough, and therefore we have seen oil prices rise, and they've been higher than we've seen in the last 3 years due to supply chain issues, hurricanes, the pandemic, and various other factors. And so that they will continue to stay on the high. And as a result, this is what you can expect in summary in terms of the utility section, is in terms of electricity, you're going to look on average at a 6% increase in electrical costs for your building. Natural gas, where it's been the highest that we've seen in many years, you're going to see a 7% climb there. And oil, so just a step back, oil we were budgeting last year at $1.75 on average. I'm not talking depending if you were burning number 2 or number 4. But last year we were budgeting $1.75, and we thought we're in a good place. This year we are going to have to budget in the range of $2.40 a gallon. What this really means is, in terms of oil pricing, in terms of per gallon, about 30% increase in terms of oil costs for 2022. So big increases, higher than normal in terms of the utilities. Again, if we look at the pie chart, it's not the biggest piece of the pie, but it's definitely, we have some other fortunate factors. We have, a lot of unknown in terms of the union contract renewal. We have going to see a little bit of tax relief in 2022. So we don't believe the overall impact for this year is going to have chronic impact on either common charge increases or maintenance increases. However, it is going to be a driving factor in your 2022 budget. Let's go to in 2000, and let's go to repairs and supplies. So we saw in 2020, and we spoke about this last year, especially with the pandemic, we saw a sharp rise in supply costs due to the pandemic, additional cleaning and PPE and sanitation protocols. And we've seen a little bit of a trend, as you can see, as we've demonstrated, it's sort of starting to equalize. However, you're not going to see your supply costs go back to historic numbers. Not only that, in terms of repairs and maintenance in general, we've all seen in terms of the pandemic, materials have gone up in price. There are longer lead times in terms of achieving necessary repairs, and therefore it's not going to be out of the norm, but you are going to see pricing increases in general repairs. Again, not more than 3 to 4%, but maybe a little bit higher than we've seen in prior years. Also, you need to bear in mind that there wasn't as much movement. There was low occupancy in the buildings last year, and therefore what we see when we review last year's numbers and we start looking at 2021 and 22, we believe those occupancy levels will resume to normal, and there will be a lot more activity in the building, and therefore repairs and supplies will be a little bit higher if we had to compare them to actual numbers when we look at 2020 going back, and even in the early part of 2021. Insurance. Now, this section, I'm going to spend a little bit of time on this section. The markets continue to be volatile due to large operating losses both on the insurance and reinsurance industries, and the trends that are contributing to these are litigation costs and large jury verdicts, social justice claims, cybersecurity claims, labor law claims, and climate change, which we're all aware of: tropical moisture, windstorms, wildfires, hurricanes, the low return on insurance, on their investments. The rates have been an influencing factor. So the industry challenges is the New York labor law claims. That's going to drive up general liability and umbrella liability costs. And therefore, it's resulted in reduced capacity and sharp price increases. The next item, which is important, is property costs. So the continued push from insurers to appropriately insure reconstruction costs in New York City. So, replacement costs and reconstruction costs have risen sharply, and we need to take that into account. And insurers are pushing for proper values, which is going to drive pricing up. And then the climate change, weather pattern changes are becoming more and more frequent and severe. So in response to the industry and from a budgeting standpoint, is we have been successful, and thanks to a rate lock agreements that we were able to negotiate. In fact, Eric McPhee and his partners, brokers through our Gotham Risk Management Group, the package policies, that's the property and liability, are much more reasonable than we had predicted, considering all these factors. And most buildings for the 2021 through 2023 years were able to take advantage of a steady 6% package policy increase for each of the next 2 years. And that period began in May of 2021. And the other factors in terms of umbrella and directors and officers costs which we, is a much smaller piece of the insurance cost for your building, are going to see further increases. And so the market continues to stay volatile. So with the 6% increase that we know of on the package, we are going to assume, considering the unknown factors, it's still a big increase, whereas, we were recommended in the 15 to 20% increase in insurance. Because we were able to receive the 6% on the package, we are going to assume a 9% increase overall for insurance costs year over year, because we still need to deal with some of the unknown factors. And that more will come in May of next year, which we will be in touch, and there will be a further insurance webinar, and we will be reaching out again to each of those buildings directly as we get updates in terms of insurance nearer to the time, which will be in May next year. So higher than increase last year, we had assumed a 10% increase in some factors, some of them higher. So we were pleased, because we were coming off a 2-year rate lock renewal, that we were able to negotiate these increases. Moving on to mortgages. Now, I am pleased to report that rates remain at a historic low. Buildings that we manage, we have looked at the possibility, and in many cases taken advantage of these low historic rates and managed to refinance the mortgage. And we really have focused and worked hard where that has been possible. There have been, in some cases, some buildings where it hasn't paid, and those prepayment penalties, and understanding newer products and what those prepayment penalties are important, making sure we have lines of credit in place, and to look forward, which is very, 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 very important, to look forward at funding capital needs. Interest rates are very, very low, and owners aren't receiving a lot of return on their own investments. And so to fund capital needs and lock in for a further 10 years at possibly under 3% or around the 3% mark, to alleviate some of the burden, has been something that many buildings have explored. And, the question always is understanding the different products that are out there, and that's important, number one. And number two is, does it pay to refinance now? And we've got to look at the savings, the cost of the prepayment penalty, and what are the next 10 years in terms of capital planning look like for the building. And then, we often get asked the question of, should we increase the size of the mortgage? Does this debt impact the value of my apartment? And really, when a buyer is buying in and their attorney is doing their due diligence, they're not focused on the size of the debt. What they're focused on is the size of your reserve account. And are you going to have sufficient funding to fund your future capital needs and maintenance of the building, or are there going to be large assessments to come? And that's what they're really, really focused on. Also, excuse me, the debt to equity of the mortgage, the size of the mortgage compared to the total value of the building is so small, generally could be around the 1% mark. And if you just did a back of the envelope, if you took the average price of an apartment, multiplied it by all the apartments in your building, came up with a value, and did that as a percentage of your underlying mortgage of your building, you will see that in most cases, generally in all cases, it's extremely, extremely low. So we will continue to explore this, and we are constantly looking at options for buildings to fund their creative ways to fund their capital needs. If you're a co-op or even a condominium, you have three options really in terms of raising funding for capital needs. either maintenance, which we don't recommend. You want to keep your maintenance to cover basic operating expenses. You do not want to distort. That's the last thing. You do not want to distort your maintenance base or your common charges, because you're a business and you want to remain in terms of it's important for value. You know, if somebody's is shopping for an apartment and they look next door and your maintenance is much higher, they might go next door. And so it's important for value that we keep maintenance equitable. But if we need to raise capital, the other alternative is assessments. And nobody likes the A word. And lastly are borrowings. And while interest rates are so low, it's something to explore and have a discussion with us about. And we will come to you with those options too. Moving on, let's talk about income. So the biggest elephant in the room, which is, commercial income, and for those buildings that have commercial income, the effects of COVID-19, as we've seen across the city, many of those tenants in commercial spaces have been forced to close their doors, and the volume is not where it was, and we're aware. We're all aware of that. The goal here in terms of how do we deal with our commercial space going forward? And that was the question. We spoke about it a little bit last year. We're going to speak a little bit about it again, is lease renegotiation. So goal one is, attempt to keep the tenant in place. You do not want vacancies. That's your number one goal. Can you renegotiate the rent? The market still, is favorable against towards tenants as opposed to landlords. Even though we are cautiously optimistic, that's a phrase that's often used to describe the current state of the retail and real estate market. But you need to consider, when renegotiating, number one is, can you achieve a deferment in rent, which would be number one, an abatement, which would be number two, and then you need to bear in mind what would be the cost to turn the space. And what I mean by the cost to turn the space, if you had to replace the tenant, just if you were fortunate enough to, put a new tenant in place, because the market, is so, it favors tenants, is they're going to be build-out costs. They're going to be free rent periods. They're going to be demands of capital outlay in terms of required air conditioning, storefronts, all that goes with putting a new, and free rent, which putting a new, and build-out costs, which is putting a new tenant in place. And we need to take all those into account, not to mention brokers' fees that would go with putting a new tenant. And so we need to take all those type of costs and build them into what you're attempting to renegotiate with a tenant, hopefully that's in place, to try and keep them in place. And so that's number one. Number two is, as landlords, we need to understand, and we knew that this was coming because even prior to the pandemic, we were seeing strain on retail. And the bottom line that we have seen on a per square foot basis in the commercial arena, a drop between 15 and 40% in terms of commercial space. And many buildings, have had to take a complete reset in terms of the market, number one. And number two, have had to institute operating assessments to cover those shortfalls to keep the building operational and maintain a balanced budget until and there's going to be a constant readjustment until we hit a new norm, whatever that new norm means. So, we need to continue to work through that. But as I said, number one, try and keep the tenant in place. You do not want vacancies. The next item in terms of income is laundry income. doesn't generally play a big factor in income, but we have seen a drop in usage because of low occupancy, which has put a huge strain on laundry vendors that provide services to your building. And so we're seeing a drop in the little income that there was, and many apartments of today have their own washer and dryer. So we're not seeing large revenue there. And then gym income. Many of the buildings, some of the gyms still remain closed. They're not at full occupancy. Those buildings that charge for gym membership, are seeing levels at 50% that they were. Again, not a huge contributing factor. However, something that one always wants to consider. We try to alleviate the burden on other shareholders. In terms of PPP loans, so during the second wave, which was the Paycheck Protection Plan, during the second window of taking the PPP loans, co-ops became eligible. And we have several buildings, about 25% of our portfolio, and there was a lot of discussion legally whether a co-op should or shouldn't, and I'm not going to get into that tonight, but we have buildings that did make the decision to move forward with a PPP loan, and this was to assist them with losses in terms of the pandemic hardships. And those loan amounts, those PPP loans amount ranged between $25,000 and $350,000, and it equated to 2.5 months of labor expenses. What happens next with those PPP loans is important. Basically, we intend to file forgiveness for all the buildings that we represent that took a PPP loan. That filing will take place in the fourth quarter of 2021. And the reason why we are waiting to file for that forgiveness is because you could elect, and they do a test period of how did you utilize those funds? Did you utilize 60% of the funds that you received towards your total payroll expense and the other 40 towards mortgage payments and utilities? And there was a test period that you could elect of 8 weeks or 24 weeks. And we elected the 24-week period. They require the third quarter tax filings in order to substantiate your claim for forgiveness. Those buildings that received under $150,000 as a PPP loan, there's a short form, and that forgiveness process should be very quick and seamless, and we are hoping to achieve that. The others that are over $150,000, the process is a little bit longer. So in terms of audit and how that's going to look and how you're going to report to your shareholders on your audited financial statements in 2022 for the 2021 audited financial statements. So if we have received forgiveness by December 31st, 2021, it will purely show as cash flow and the proceeds are not taxable. If the forgiveness is still pending, okay, it's going to show on your balance sheet as a loan payable. And if it's not forgiven by any chance, and we doubt that any loan will not be forgiven, but in the off chance that a loan is not forgiven, okay, the loan will be fully amortized, so you will be able to pay it over 5 years, and it will accrue an interest rate of 1%. And this will be reflected in the notes of the financial statements. The one item that I just wanted to touch on was the condominiums in terms of let's talk cash flow. And the point that I wanted to make in terms of condominiums is that it's very, very important that you're vigilant. We all need to be co-ops and condominiums in terms of arrears. And we've been very fortunate that we've not had many shareholders or unit owners with hardship, but we're at a condominium where the co-op stands before the bank in terms of collecting maintenance. A condominium does not. And so we have to be, in terms of cash flow, very, very vigilant in continuing to monitor those arrears. So that really brings me to the end of our presentation tonight. I apologize, I ran a little bit longer than I intended to, but we do have a few minutes to take some questions from the floor, as it were. And if you can see, there's a Q&A, and you could put your question into the chat. Robbie Janowitz, who is assisting me tonight, so thank you, Robbie, is going to read those questions, and I will do my best to answer them to the best of my ability. And if we don't get to all your questions this evening, we will get back to you. And please, again, don't hesitate to reach out to me, and I'll finish that up at the end. You can reach out to me directly, and I'll be happy to have any detailed discussion. I will be meeting with most of you directly to discuss your budgets in the next few weeks, but if you have any specific questions, I'm happy to answer them directly. So Robbie, let's
Sure. So there are two questions so far. The first one is, what's the outlook for environmental legislation that may trigger CapEx needs for a building? For example, convert oil burner to natural gas.
So there are various compliance and climate mobilization that is coming down the pike continually. Basically, my suggestion is, and we are working with building engineers to review your energy grades and work through that. But they are going to, depending where you're at in those type of processes, there will be further capital needs, definitely in the next 10 years, that buildings are going to have to undertake.
Thanks, Andre. The next question, someone's just trying to reconcile two statements. One is, you advise not collecting funds for anything other than operating expenses, keep maintenance low to preserve value. You note that buyers look at reserves, not debt, and reserves improve value. Reserves have to come from somewhere. If not maintenance and assessment, are you advocating borrowing to fund a reserve?
Okay, I think it's important that I clarify that. So when I did keeping maintenance low, I don't mean unrealistically low. What I mean, and this is important, is that maintenance needs to cover the operations, the day-to-day, the normal operations of a building. What I'm saying is, in terms of raising monies for capital needs or special projects, should be done by billing it as a separate line item, either as an assessment or as a capital contribution. And it's very, very important to define that it's either an operating assessment, depending on what it's going to be used for, a capital assessment, or a capital contribution. And this goes a little bit further, because if a building finances their capital needs via borrowings, okay, shareholders or unit owners cannot take the step up in terms of the cost basis. If they bill their capital needs to raise the funds via a capital assessment or a capital contribution, that is classified as paid-in capital, and therefore they can add it to their cost basis. So I'm not advocating for unrealistic low maintenance. I'm not advocating for borrowings as such. What I'm stating is that should you raise capital, you should not raise capital via your operating maintenance or common charges. You should raise capital as a separate billing line item, as either a capital assessment or capital contribution. In terms of borrowings, interest rates are low. Boards and buildings, and there are people that are adverse to debt, and it's not for everybody. And it's a policy of the board and the building where they don't want to fund capital needs. They believe it should be as a pay-as-you-go, or to continue to build a reserve fund by a small portion, which I would recommend billing it as a capital contribution, then building it into your maintenance, that you could add it to your cost basis that way. But I'm not advocating, borrowings versus assessments. Either way, It's definitely a board policy and a building position. But what I am advocating is that if you do raise capital, do it, don't build it into your maintenance.
Andre, there was a question that came in that said, can you provide the charts with the trends on increased costs for energy, labor, et cetera? It would be helpful to use in communicating to shareholders.
Absolutely.
And I don't see any other questions at the moment.
Well, if that, it brings us to the end of our presentation. And, again, if you have any specific questions, you can see my email address on the screen. This webinar will be circulated to all of you, so you'll have the slide deck and these charts, and we will work with you in communication with those charts to your residents. We're happy to share. We really appreciate you taking this time to attend this webinar, and I look forward to seeing you all soon virtually as we work on your specific budget. So I wanted to thank you. Thank you to my whole team for assisting me, Robbie and Chelsea Shapiro behind the scenes. I'm doing all our invitations and reminders and helping me get set up. So I appreciate that, and wishing everybody a good night. Thank you, everybody.